When you're just starting out, it may seem like all you can afford is your rent, credit card, or utility bills, groceries, and loan payments. But after you've gotten the hang of setting aside money for those regular expenses, it's time to begin investing. Choosing what to invest in and how much to invest is the challenging part. You'll have a number of questions as a beginner in the world of investing, like, how do I start? Or what are the top investing tips for beginners? Today, we will be answering all those questions and a whole lot more. Here's what you need to know to start building your financial freedom and wealth. Number 1, invest for the long term. You must never lose money. Warren Buffett, the investment genius, developed the golden rule of investing, and by using it, he has earned enormous wealth. The simplest method to achieve this is to invest when an option is undervalued at attractive prices. In doing so, you will be paying less than the actual price, which might subsequently help you make a lot of money once things get back to normal. Even while taking chances is wonderful, be sure they are well-considered ones. Avoid investing in the short term because it is quite risky. Instead, search for long-term investment opportunities with reliable returns to reduce risks. Rather than short-term trading, Warren Buffett has acquired his riches through long-term investments. Sure, some people have made fortunes via speculation, but a lot more people have also done the exact thing and suffered losses. Short-term trading involves numerous fees that must be paid, as well as numerous risks that could lead to significant losses. This longer-term trading, which has become more crucial over time, is how many other billionaires made their fortune. Number 2, create a portfolio plan. Determine your goals at the beginning, including how much you want to earn in the long haul. What is your ideal net worth? Beforehand, ask yourself these kinds of questions, then build a plan. From there, decide which investment opportunities are profitable and whose rate of return would allow you to achieve your financial goals within the specified timeframes. When choosing your investments, use this as a reference. Number 3, model your investing by paper trading. Consider this a practice run before you make actual investments. What do you have to lose by starting here? Paper trading enables newbies to gain real-world experience without taking financial risks. Using this method, you can trade and invest in stocks, keep track of your gains and losses, and do pretty much everything you would have done in the real world. You can practice your abilities for free on a variety of platforms now. Number 4, invest in quality stocks. One of the finest strategies to invest your money as a novice can be to acquire shares in a single firm. You may make a significant amount by investing in the right business. The method we're about to share with you is the same one that Warren Buffett has applied for the past decades to exploit the markets. So, as a newbie, how does one invest? The right firm and the proper timing are the most crucial considerations. You will need to conduct study on the chosen organizations by examining their management, past performance, financial statements, and moat. Don't make an investment as soon as you find a firm that fits your standards. Put the business on your watch list for a while. Check for price drops while you're waiting. Buy once the stock's price drops. Once the company reverts to its real value, you'll get a terrific deal and make a profit from this. It's crucial to control your emotions while investing. Recognize that markets may be extremely unpredictable, and even the finest companies can suffer declines. Don't panic or take rash actions as a result of any significant changes. Wait, have patience, and carefully consider the situation instead before making any decision. The advantage of investing today is that little capital is required. You may begin for as low as $1,000 and quickly expand it to tens of thousands of dollars. Make sure to stay away from penny stocks when investing. Stocks of companies with a market value of less than $5 are known as penny stocks. Because these stocks are inexpensive, they may be appealing. They are, however, extremely volatile, and there is limited to no information online about the companies. The majority of penny stocks belong to small, newly established businesses. Number 5. Consider investing in exchange-traded funds. Index funds and exchange-traded funds, or ETFs, are very similar. They follow the same investing strategy and a certain market index. In comparison to mutual funds, these frequently have lower fees. The primary distinction between the two is that the ETF is traded during the day and has a fluctuating share price. The minimum amount of investment for the ETF is this share price, which may range from less than $100 to as much as $300. They have helped a lot of people financially, but they also call for a lot of diligence and research. You will need to commit a large amount of time, if not as a full-time investment, to actually thrive with them. Number 6. Consider robo-advisors. These are robots, as the name would imply, that provide financial services including portfolio creation and investment choice selection on behalf of people. Robo-advisors are an excellent choice if you have little experience with investing. All of your investments will be managed by robo-advisors utilizing computer algorithms. Their systems have low operating expenses, thus fees are considerably less than paying brokers to administer your account. Using a robo-advisor would cost you around 0.25% to 0.50%, whereas hiring a personal financial advisor would cost you between 0.5% and perhaps even 5%. This is a simple solution if you are a beginner and don't have a significant amount of cash. However, we're not advocating that you hand over complete control. You still need to keep an eye on where your funds are headed. Some advisors provide educational materials and practical tools that could enable you to learn more about the procedures if you have a similar interest in learning. It's a more reliable, practical, and affordable method to invest. Number 7. Leverage investment apps. The day has been saved, or rather, novice investors have been saved by technology. There are many investment apps available now that cater to new investors. A few even round up your credit or debit card purchases and invest the difference in an ETF portfolio. These apps will handle your portfolio and function as robo-advisors. There are a ton of apps that will teach you how to invest if you decide to do it yourself. Most have extremely low costs and are practical because you may access them whenever you want on your devices. Number 8. Invest in an index fund. Index funds can be best described as automated mutual funds. It is an excellent substitute for employing a portfolio manager to do it for you. An index fund, however, will track a certain index. A group of investments that each reflect a portion of the whole market is referred to as a market index. The S&P 500, which includes the stocks of 500 of America's largest companies, is a perfect illustration. The S&P 500 fund will buy the stocks of these firms and track their performance. Due to the fund's passive strategy to investing, which includes tracking the overall market index rather than appointing a real professional portfolio manager, expenses are lower. When you invest in index funds, much like mutual funds, you will be buying a portion of the entire market at once. Index funds frequently have minimum investment requirements, but a few brokerage funds don't. How incredible is that? Long term, this investment choice is preferable. Number 9. Retire by investing in target date mutual funds. These funds are comparable to retirement plans. The expected retirement year will be taken into account automatically when making investments with this choice. A mutual fund is a collection of several investments, and when an investor purchases a share, they are simultaneously investing in all of the fund's holdings. These funds are managed by qualified professionals who decide how the fund will be invested. However, most funds have a specific theme. Number 10. Take advantage of an employment retirement plan or 401k. The greatest place for a newbie investor to start is with a retirement plan. Some employers will match your contribution. The great thing about this investment strategy is that you may get started with as little money as you can manage. The sum will be automatically taken from your account when you select a plan. Since the majority of retirement plan deductions are paid before taxes, you end up saving far more money over time. In order to increase the value of your money, the power of compounding is also essential. Through compounding, a small monthly investment might accumulate into a sum of money after a number of years. That concludes today's video, which we hope you enjoyed and learned something from. Tell us about your investment journey in the comments section below. Give this video a thumbs up if you liked it, and consider subscribing to the Inlet Financial Coaching channel if you haven't already. Thanks for watching, and we'll see you in the next video.